It's an interesting sort of juncture for the markets as well. They seem to be anticipating that the cut they didn't see coming at all could come as soon as next month. Well, we're not going to go into detailed interest rate policy with Alan Greenspan. We are going to get the lay of the land from arguably one of the most historic Fed chairman the nation's ever had. Alan Greenspan, the former chairman of the Federal Reserve, with us right now. Dr. Greenspan, good to have you.
I'm glad to be with you.
First, on this expectation for a cut, not so much whether it will happen, Doctor, but that people seem to be okay if it does. What do you make of that?
Well, first of all, let me just say that what the Fed does at this particular stage is less important than what the markets are doing. And what the markets are beginning to show us is an acceleration in money supply for the first time in a very long time. I mean, M2, I don't mean the huge balance sheets of central banks, but we have a global problem of a shortage in productivity growth, and it's not only the United States, but it's pretty much around the world, and it's being caused by the fact that the populations everywhere in the Western world, for example, are aging, and we're not committing enough of our resources to fund that. We should be running federal surpluses right now, not deficits. This is something we could have anticipated 25 years ago, and in fact we did, but nobody's done anything about it. And this is the crisis which has come upon us. It's slowing productivity because entitlements are crowding out savings and hence capital investment. Capital investment is a critical issue in productivity growth, and productivity growth in turn is the crucial issue in economic growth. So we're running at the end of this period to a state of disaster unless we turn it around.
But no one shows the willingness, to your point, Alan, to do anything about it on the right or the left. On the left, more talk of more spending, and on the right, more talk of bigger tax cuts without paying for them. And we're expecting to hear later on in this hour from Donald Trump, speaking of North Dakota. He has been loath to touch entitlements, and that could explain, I guess, the bumpy relationship he's had with Speaker Ryan, who has yet to endorse him. What do you think of that Trump position not to touch entitlements, at least for the time being?
Well, I think this should be the central issue of the presidential debate, because unless and until we can rein in entitlements, which have been rising at a 9% annual rate in the United States and comparable levels throughout the world, we're going to find that productivity is going to maintain itself at a very low rate of increase. And indeed, it's very likely that the productivity increase for the first half of this year could very well be close to negative, certainly for the first quarter or the fourth quarter of last year. But it's hard to know how the data are going to get revised.
But do you think we're heading into a recession? Do you think we're heading into a recession?
I don't think that's our problem. Our problem is not a recession, which is a short-term economic problem. I think we have a very profound long-term problem of economic growth at the time when in the Western world there is a very large migration from being a worker into being a recipient of social benefits, as it's called. And this is legally mandated in all of our countries. The size has got nothing to do with the rate of growth in economic activity. But if we stay down at the 2% economic growth or less in the United States and elsewhere, we're not going to be able to fund what we already have legally obligated to spend. So this should be where the debate is. It shouldn't be on 20 million different irrelevant issues. This is the most fundamental thing confronting not only our country, but all of our allies, and to a very substantial extent by, frankly, indirection, the developing world as well.
But neither of the prominent candidates in this country are addressing that. And I guess what I'm asking you is, if you had to choose, I mean, whose policies were least worrisome, whose would they be?
Well, I happen to be a fan of Paul Ryan's, who I think is a very sensible political economic type, and
well, he's not a fan of Donald Trump. As you know, he's not committed to Donald Trump yet. Are you surprised?
I'm not surprised at all.
Are you a fan of Donald Trump?
Not exactly.
So if we were between he and Hillary Clinton, where would you go?
You're giving me a very tough choice, and I think at this stage I will not comment on that issue. I have yet to figure it out.
But you know, when I had David Stockman here, as you know, Ronald Reagan's former budget director, the guy who was brought to the woodshed for famously warning at the time of the deficits of the debt to come. The argument back then was that the economy would boom, and it did, from not only dramatic cuts in interest rates under your predecessor, Paul Volcker, but the tax cuts that Ronald Reagan and his enthusiasts say really sparked the economy. What happened, I think as you pointed out, Doctor, is with all those extra revenues, Republicans proved just as skillful at spending that money and then some as Republicans have claimed Democrats are. So I wonder whether you agree with Mr. Stockman that it could be too late, that we could be on the verge of a big old market economic collapse. That's what he said.
I would certainly not go that far, and we needn't go that far. And in fact, it strikes me that if we all were to get together and have a real debate, and you're quite correct in saying this is a bipartisan issue. Entitlements are the third rail of American politics. The politician who touches them loses. And so we have a 9% annual rate of increase in entitlements, which is mandated by law. It's got nothing to do with the economy. It's got to do with age and health and the like. And we don't have the economic resources to fund that unless we can curtail entitlements. The data show, shockingly, that since 1965, the sum of gross domestic savings and entitlements as a percent of GDP has been remarkably flat. And what that tells us is all the way back to 65, we have essentially been seeing a $1 to $1 trade-off between entitlement growth and gross savings decline. And that, despite the fact that we are borrowing savings from abroad, has kept our rate of capital investment as a percent of GDP going down. That in turn has meant that productivity has slowed down, which means that economic activity will slow down, which means that entitlements will be more and more of a problem. And there's no way out of this except to confront it straight on. And this is where the debate ought to be, because everything else, frankly, will turn out to be peripheral.
Well, you're right about that. But let me ask you, though, if you could help me with this. I mean, there are fears, you know, given some of the run-up recently in housing numbers. In fact, home sales in the latest period running up at a 16.6% clip, quickest advance, biggest advance in 24 years. Some were worried. I say worried in a good way, that we're looking at another potential housing bubble, that interest rates have been so low for so long that it's created a new bubble and maybe something that could produce another housing meltdown. Do you share that?
There are lots of problems of a cyclical nature out there, but I think that the secular problems, that is the long-term problems, are so commanding at this stage that we really have no choice but to focus directly on how to solve this. We have to right now figure out a way of getting surpluses in our budgets throughout the Western world, because Europe is in trouble, we're in trouble. In fact, Japan is in worse trouble. Right. Japan's problem is, of course, as you know, is they're aging very rapidly.